Well, our next guest says the best way for investors to weather uncertainty is to layer their portfolios into bonds, correlated and non-correlated investment strategies. Richard Saperstein is a managing director at Treasury Partners. It's a division of HighTower Advisors. He oversees $8 billion in assets. Well, since 2004, he has ranked in the top tier of Barron's annual listing of America's top 100 financial advisors. Richard, good to have you here on Fast Forward. Welcome.
Thank you.
Interesting stuff Sheila was just talking about there, looking at the rush into investment-grade corporates and even high-yield corporates, for that matter. Tell me if you're seeing that reflected in what your clients are looking for, and what are you recommending?
Absolutely. Well, as a result of the potential downgrade of the U.S., there's 4 corporations right now that are rated AAA, and they'll see more of a bid. In addition, we'll see more emphasis placed on non-U.S. issuers that issue in U.S. dollars. They'll be a good substitute in the event of a downgrade of the U.S.
Let's talk about how you've looked at grouping different asset classes. You have 2 groups, basically. You call them correlated strategies and non-correlated strategies.
Correct. For decades, investors put portfolios together with asset classes that were like large cap, mid cap, and small cap, and under the belief that putting them together resulted in favorable risk-return characteristics. What happened in the crisis was that everything became perfectly correlated and went down. So we took a look at all the asset classes and reordered them and looked at what was correlated and what was non-correlated. So going forward, we're now putting portfolios together with a keen sense of structuring the portfolios for lower risk return based on the correlations with the S&P. So if there's another 30-year flood like occurred in '08, invested portfolios should have greater protection.
So you try to do what? Is it 50% correlated, 50% non-correlated, or how do you manage your asset allocation based on that?
Depending on the risk-return objectives of the portfolio, we start off with a layer of bonds, which provide safety or ballast or assets to reallocate in the event of a market downgrade. And then we add market-related or correlated asset classes like large cap, small cap, mid cap, could be REITs, emerging markets, international. And then we add non-correlated strategies, which are alternative strategies. Could be commodity trading, long-short strategies, multi-strat funds, but various portfolios or investment strategies that have exhibited low correlation to the market.
Right, so that if there is a complete Armageddon, we're assuming it's not complete Armageddon. At least some asset classes will be moving in the opposite direction, going up as opposed to down. Let me talk to you, speaking of what's going up versus what's going down, the short end of the curve, the Treasury curve. It's something we've been talking about. Early in July, there were actually negative yields at the very, very short end of the curve. Of course, we've seen that reverse quite rapidly over the last 2 weeks. And the August 4th T-bill, of course, the first one due after that August 2nd deadline, is now at about 20 basis points yield. That reversed dramatically in just about 2 weeks.
Right.
We're not seeing that come down. Not a surprise. We've only got 2 more days or 3 more days until payments due. What about the rest of the short end of the curve? Do you think that we'll see those yields fall down once again?
Yeah, so the short end of the curve is anchored based on Fed policy, which will remain on hold for at least another 12 months. And the real big fish in the sea is going to be the economy. And that's the big issue that the bond market has to wrestle with. So once the issue in Washington gets cleared up, we're still going to deal with the slowing economy.
Is that your biggest, amongst your clients, and you can separate them out, is it the economy that's the biggest concern to them right now? Where does Washington factor in? Where has been the latest talk of default, talk of downgrade, ratings agency downgrade factor in?
I think the fall registered very high with clients. Downgrade is a less concern to the clients, and in our view will be a nominal event on market values of securities. The real driver of the market value of securities will ultimately be the slowing economy, and we got some numbers today which really reinforces that.
All right, Richard, we're going to have to leave it there. That was Richard Saperstein joining us today, giving us some very interesting insight into what a number of his clients are thinking. He's a managing director at Treasury Partners, which is a division of HighTower Advisors.